The Federal Reserve, often called the Fed, is the central bank of the United States. It's like a big bank for all the other banks. The Fed has a very important job, keeping the U.S. economy healthy. It does this by controlling the amount of money in circulation and setting interest rates. The Fed's decisions have a big impact on the stock market. When the Fed lowers interest rates, it becomes cheaper for businesses to borrow money. This can lead to economic growth and higher stock prices. On the other hand, when the Fed raises interest rates, it can slow down the economy and cause stock prices to fall. Interest rates are like the price of money. When you borrow money from a bank, you have to pay interest. The interest rate is the percentage of the loan amount that you have to pay back on top of the principal. The Fed sets a key interest rate called the federal funds rate. This rate influences the interest rates that banks charge each other and, ultimately, the interest rates that consumers and businesses pay on loans. When the Fed lowers the federal funds rate, banks usually lower the interest rates they charge their customers. This makes it cheaper for businesses to borrow money and invest in growth. Lower interest rates also make it less attractive for people to save money in banks, so they may invest in the stock market instead. Lower interest rates can be a boon for businesses. They can borrow money at a lower cost, allowing them to invest in new equipment, hire more employees, and expand their operations. This growth can lead to higher profits, which can boost stock prices. Investors take notice of these positive economic signals and often buy more stocks. Higher interest rates have the opposite effect. They make it more expensive for businesses to borrow money, which can stifle investment and economic growth. This can lead to lower profits and potentially cause stock prices to fall. Investors may become more cautious and sell stocks, anticipating a slowdown in the economy. One of the Fed's primary goals is to keep inflation under control. Inflation is a general increase in the prices of goods and services. When prices rise too quickly, it can erode the value of money and make it harder for people to afford basic necessities. The Fed can use interest rates to try to control inflation. When inflation is high, the Fed may raise interest rates to slow down the economy and bring inflation back down to a target level. This can sometimes be a delicate balancing act because raising interest rates too aggressively can also lead to a recession. Section 5. Unemployment as an economic indicator. Another important factor that the Fed considers is the unemployment rate. The unemployment rate measures the percentage of people who are actively looking for work but cannot find jobs. A low unemployment rate is generally a sign of a healthy economy. When unemployment is low, it can put upward pressure on wages as businesses compete for a limited pool of workers. This, in turn, can contribute to inflation. The Fed may raise interest rates to prevent the economy from overheating and keep inflation in check. Section 6. Recent market trends and the Fed's influence. In recent years, the stock market has experienced periods of both significant growth and volatility. Factors such as technological advancements, geopolitical events, and the COVID-19 pandemic have all played a role in shaping market sentiment. The Federal Reserve's actions have also had a notable impact on market trends. During the pandemic, the Fed implemented emergency measures such as slashing interest rates to near zero and purchasing large amounts of government bonds to support the economy. These actions helped to stabilize financial markets and prevent a deeper recession. Section 7. Historical examples of the Fed's impact. The Federal Reserve's decisions have historically had a profound impact on the stock market and the broader economy. One well-known example is the Fed's response to the 2008 financial crisis. As the housing market collapsed and the financial system teetered on the brink, the Fed took unprecedented steps to avert a complete meltdown. The Fed slashed interest rates to near zero, provided emergency loans to banks, and launched a massive program of quantitative easing, which involved buying trillions of dollars of government bonds and other assets. These actions helped to stabilize the financial system and eventually paved the way for an economic recovery. Section 8. The importance of understanding the Fed. Understanding the role of the Federal Reserve is crucial for anyone interested in the stock market or the economy as a whole. The Fed's decisions on interest rates, inflation, and other economic factors have a direct impact on businesses, investors, and consumers alike. By staying informed about the Fed's actions and their potential consequences, individuals can make more informed investment decisions and better navigate the complexities of the financial markets. Section 9. Conclusion. The Fed's ongoing influence. The Federal Reserve plays a pivotal role in shaping the U.S. economy and, by extension, the stock market. Its decisions on interest rates, inflation, and other key economic variables have a far-reaching impact on businesses, investors, and consumers. As the economy continues to evolve, the Fed's actions will remain a focal point for market participants and policymakers for years to come. Please like, share, and subscribe to our channel for more insightful content.